So I want to go through somewhat of a comprehensive example of the concepts that we are working with this week. And to do so, we're going to assume a company that makes boats. And you can see at the top of the spreadsheet, I've given us some data, budget and actual, for the manufacturing costs, direct materials cost, direct labor costs, manufacturing overhead costs, and well, as I mentioned, we've got the budgeted amount and the actual. Then an additional piece of information is that we are going to allocate manufacturing overhead based on direct labor costs. Keep in mind that direct costs we can easily trace to our individual jobs because for materials, we know the production manager has requisitioned those costs for a specific job. Direct labor, we know the laborers have put their time into a particular job. Manufacturing overhead, if you remember from last week, however, is an indirect cost. There is not a direct relationship, so we have to find a way to allocate it. And the first step in that process is to identify what we think is the most appropriate allocation base. Usually you want to look for a cause and effect relationship. It may not be perfect, but if you can look for the best cause and effect relationship, then you'll at least have as good an allocation as you can expect to. So in this particular example, we have decided that direct labor costs may be the primary driver for our manufacturing overhead costs. So that's what we're going to allocate based on. Then additionally, I've given us some information for a specific job that we're working on, job number 12. And you can see we have incurred $50,000 in direct materials on job 12, $18,000 in direct labor. The unknown here is how much do we need to allocate to this job in terms of manufacturing overhead. So there are a couple of ways to think about allocating overhead. What we effectively need to do is come up with an allocation rate. How much per direct labor cost are we going to allocate to each job? We can do that using the actual costs and come up with an actual indirect cost rate. This is called actual costing. And what we're doing there is you can see the formula. We're basically just taking our actual manufacturing overhead costs and dividing them by our actual direct labor costs, the allocation base. And when we do that, we come up with an allocation rate of $1.05 or 105%, which basically says for every dollar of direct labor that we incur on a particular job, we will allocate $1.05 in overhead costs. Now, with that, if we go down to job 12, then we would take the $1.05, multiply it by the $18,000 in direct labor costs, and that tells us that we need to allocate to job 12 $18,900. Once we do that, we can come up with a total cost of job 12, which includes the $50,000 in direct material costs, the $18,000 in direct labor, and the $18,009 in allocated manufacturing overhead costs for a grand total of $86,900. Now we have the ability to calculate the price if indeed we use a cost plus markup to come up with the price, or if we already have a contract price on this job, we can come up with our profitability, but we have the data we need. Now, there's a problem because we have calculated this overhead rate using actual overhead costs and actual labor costs. When do we know that? Well, the bottom line is we don't know that until the end of the year. And so if we're working on jobs throughout the year, we are put in a position of not being able to fully cost our jobs until we get to the end of the year and can calculate this overhead rate. You say, well, maybe you could do it monthly or quarterly. And we could, but oftentimes you have overhead costs that are seasonal. In summertime, you've got more electricity because of the air conditioning running. In the winter, you may have more gas costs because of heat running. And so what happens is, because of seasonal costs, you may end up with a job costing more or less than another job merely because the overhead rate that they used was calculated in a different season. And that can be problematic. So what do? Well, the best thing to do is to calculate what's called a predetermined overhead rate, which is, when you do that, you're using what is called normal costing. Normal costing is when your direct costs are actual, but your predetermined overhead rate is based on budgeted. And so you can see our predetermined overhead rate here is calculated by taking our budgeted overhead divided by our budgeted direct labor costs. And that's a number that we can calculate at the beginning of the year, and therefore we can come up with a total cost of a job at any point in time throughout the year. Now, is there some inaccuracy? Sure. But remember last week when we talked about some of the trade-offs in managerial accounting, we're going to trade off the accuracy for the ability to come up with a more timely number. So if we recalculate the indirect or manufacturing overhead costs allocated to job number 12, we're going to use the $1.15, multiply that by the $18,000 direct labor costs, and we come up with $20,700 in manufacturing overhead costs allocated. That then will change the total cost of the job. Direct materials, direct labor, that doesn't change. The only thing that's changing is the manufacturing overhead costs, and that is now going to be $20,700, which means the total cost of the job is $88,700. Now, what this means, though, is that the actual amount of overhead that we end up incurring may be different than what we apply to jobs. This is going to be referred to as under or over applied overhead. And we will have to deal with that at the beginning of the year. And later on in this example, I'll walk through how we deal with it. Okay, let's go to the second page of this worksheet. And I want to walk through the actual journal entries that we make that reflect that flow chart that I had gone through in the other video. And to do that, I want to give us a little more data. So that $1,155,000 in manufacturing overhead is broken out into four segments, components. Indirect materials of $410,000, $200,000 in indirect labor, $97,500 in depreciation, and then $447,500 in other expenses. This may be rent, it may be utilities, it may be the cost of supplies for the employees, any number of different types of expenses that were incurred because of the manufacturing process. Then, during the year, we purchased raw materials of $3.9 million. At the beginning of the year, we had raw materials inventory of $350. At the beginning of the year, we had work in process of $125,000, finished goods of $225,000. We completed and moved to finished goods $5,750,000 worth of goods. And then we sold and moved cost of goods sold $5,840,000. And we sold, those goods were sold for $8,176,000 in revenue. Okay, so I'm going to walk through the journal entries here for various things. To purchase the raw materials, that's simply going to be a debit to raw materials inventory. And I'm just assuming accounts payable, a credit to accounts payable. Nothing new there. To record use of materials, we will debit work in process for the direct materials from, I got those from the previous worksheet, because remember the flow chart. Think about that flow chart as we go through these journal entries. When you buy direct materials, they're going to go straight into work in process. Or when you use direct materials, they're going to go straight into work in process. We're debiting manufacturing overhead for the indirect materials because by virtue of them being indirect, we're going to have to allocate them with overhead. And then we'll credit raw materials inventory for the total. Everything came out of raw materials inventory. Where it went depended on whether it was direct or indirect. Okay. Then labor costs, we're going to basically do a similar type thing. We're going to debit work in process for the direct labor, which again came from the previous worksheet. We'll debit manufacturing overhead for the indirect labor. Same rationale as for the indirect materials. There's no way to directly trace it. And then we'll credit payroll payable for the total. The depreciation that is included in manufacturing overhead, we're going to debit manufacturing overhead for that because again, it is related to the manufacturing process and therefore should be included in it. We'll credit accumulated depreciation. You may remember this entry from financial accounting. Typically, we would debit depreciation expense and credit accumulated depreciation. But because this depreciation is product related, it needs to follow the product and go through manufacturing overhead. The rest of the overhead costs will just debit to manufacturing overhead and then credit whatever's appropriate, accounts payable, prepaid expenses, cash, whatever it might be. So now we have all our actual costs recorded. Now we need to apply the manufacturing overhead. And we're going to apply manufacturing overhead by debiting work in process and crediting manufacturing overhead. And we're going to calculate that by taking that overhead, predetermined overhead rate that we calculated on the first page of 1.15, and we'll multiply it by the actual direct labor costs. And that gives us $1,265,000 of overhead that's being applied. We debit work in process and credit manufacturing overhead. One thing to think about if you look, and we'll look at a T account in a minute, but if you look at a T account for manufacturing overhead, the debits are going to be your actual overhead costs. The credits will be what is being removed from manufacturing overhead and applied to the specific jobs. Now, the $5,750,000 that we actually finished, we will debit finished goods and credit work in process, taking it out of work in process into finished goods, indicating it can be sold. And then to record the goods that we sold, we'll debit accounts receivable and credit sales revenue for the sales. And then the cost, we will debit cost of goods sold and credit finished goods. And those numbers just came from above. Those two entries you should be familiar with from financial accounting. Now, let's look at the T accounts. Raw materials. You'll notice that I started with the beginning inventory. I added in the $3,000,009 that we purchased, that came from our first journal entry. Where is it there? And then I credited $3,960,000 from our second journal entry for what we used. That leaves us with, at the end of the year, $290,000 in raw materials. Work in process, again, we started with beginning inventory. We debited work in process for the direct materials. We debited work in process for the direct labor. And we debited work in process for the manufacturing overhead that we applied. Our credit to work in process is the $5,750,000 that represents the goods that we finished and moved on out to finished goods. Then when we calculate the ending balance, we end the year with $290,000 still in work in process, representing the costs that are associated with the goods that we haven't finished. Okay. Finished goods, T account. Again, we'll start with our beginning inventory. We'll debit finished goods for the $5,750,000 that we moved in there from work in process. We'll credit finished goods for the $5,840,000 that we sold. And at the end of the year, we have $135,000 sitting in finished goods. Manufacturing overhead. We'll debit it for $410,000. That is the indirect materials. We'll debit it for $200,000, the indirect labor. We'll debit it for $97,500, the depreciation. And debit it for $447,500, which is the other manufacturing overhead costs. Then we credited for $1,265,000, which is the amount that we applied to work in process. Now, I'm going to move this out. At this juncture, we actually have a credit balance of $110,000. Now think about what that tells us. If we have a credit balance, that means if our credits are what we applied and our debits are what are actual, that we applied more overhead to jobs than we actually incurred. And again, this is because we used that predetermined overhead rate that was based on budgeted numbers. We applied $110,000 more than we used. Now, there are a couple of ways that we can deal with this, and we have to deal with it. The easy way is just to write it off to cost of goods sold. The rationale there is ultimately all of your goods are going to wind up running through cost of goods sold. So to allocate it to cost of goods sold, we can, it's basically just a timing issue. And keep in mind, the allocation by definition is not an exact science. It's an estimate. So as long as our budgeted numbers are fairly reasonable and we have a decent budget process, then our under or over applied overhead should be immaterial, and writing it off to cost of goods sold is not going to distort your financials. And because it is easier than the alternative, it is less costly. The alternative is to take that, in this case, over applied overhead, and allocate it between finished goods, work in process, and cost of goods sold. Because if you think about it, the goods that have manufacturing overhead applied in them are in one of those three accounts. They're either goods that we aren't finished with yet, which would be work in process, goods that are complete but not sold, which would be finished goods, or goods that we've sold, which would be cost of goods sold. So we could allocate it proportionally between those three accounts, but bottom line is very few companies do that. Most companies go for the write-off to cost of goods sold approach. And that is what my journal entry here has done. Notice it's over applied, so to zero it out, and that's what your ultimate goal is. You want to zero out manufacturing overhead. You're going to debit manufacturing overhead, and you can see how that zeroed the account out, and you're going to credit cost of goods sold. So ultimately, if you look at the cost of goods sold T account, your adjusted cost of goods sold is less than what you actually debited cost of goods sold for, because you are reducing it by the overhead applied over and above what you actually incurred. And again, this is the approach that most companies use. If it had been under applied manufacturing overhead, this journal entry would have been reversed and adjusted cost of goods sold would have been higher.